Hey guys, welcome back. And recently, in the past week, we've had a lot of news coming out with Q2 earnings being released for a lot of financial institutions, as well as companies like Tesla, ASML, and Netflix. And in this news, we're going to break down this first large week of earnings and see what's likely to come for the markets and the next few weeks of earnings with big tech and companies like SoFi, New Bank, which I'm invested in, reporting as well. So with that, let's get right into it. Now first, with financials, despite the talks of a hard landing over the past few years and even the more recent collapse of Silicon Valley Bank, we saw promising results from the top three financial institutions, JP Morgan, Wells Fargo, and Citigroup, as they beat expectations and have eased the mind of many as they usually set the tone for the rest of the earnings season as a whole. Now all of these banks reported strong net interest income and really surprised a lot of the analysts, as many were expecting a harder drop and more difficulty to beat the earnings. Although the bigger and systemically important banks have already reported, I'm looking forward to SoFi, which comes out around July 31st, and New Bank, which comes out around a month later, as I think they are faster growing and more indicative of what fintech and the banking sector in the future will be headed towards. Now moving on from financials, Tesla had a huge earnings report and a subsequent fall of over 9% the following day. Now, Tesla earnings remain strong as they saw continued growth through all of their business segments, including energy, automotive, services, and a few other. And another bright spot of their earnings was the Model Y being named the top car in the world for the second quarter in a row. They also produced their first Cybertruck this quarter, stating that they will be delivering some in 2023, but will be making them in high volume next year. Although Musk did mention ramps are hard to predict. Tesla saw a year-over-year automotive increase in sales of over 46%, as these cars have been flying off the shelf before they can even be made. And honestly, no news in this report was too unexpected, and it just served to confirm the bear and bull cases for Tesla. Now, bears are claiming that the lowering in margins on their cars is showing signs for weaker demand, and that since it's just still a car business and the margins are dropping, it shouldn't be valued as high as it is currently. And the bulls are still really looking at their other segments of their business that are faster growing and have even higher margins. They also mentioned that in their report, research and development costs rose over $200 million this quarter, and claimed that the reason for this was to stay at the forefront of AI. And they have committed to building even more of their supercomputer, which is said to cost over $1 billion in the future. Although many investors hate to see companies spend money like this on research and development, as there's no direct or soon to be realized gain from that, it can be really good for the future of Tesla's business, as who knows how this will affect their full self-driving and in the future even their Tesla bot, and whatever other projects that this AI can apply to or be licensed out to other companies. Regardless of your position on Tesla, it is clear that their automotive business is growing rapidly, as they have seemingly unlimited demand, which can then subsidize their higher margin, faster growing businesses that will then potentially maintain elevated growth for a sustained period of time. Elon Musk also mentioned in their earnings call that he could see the company being 5 to 10 times the size of it is today. Although that's awesome to be excited about, he does have a tendency to say things like this to get people excited, and for the most part, eventually, it does come true. But it's important to taper expectations when investing and not get emotional, as many people see a lot of loss in the volatility that Tesla brings in their stock price. Now, I remain long on Tesla, and I think they will continue to outperform the S&P 500 over the next 5, 10, and probably even 15 years. Now, moving on to Netflix, Q2 was a huge quarter for Netflix as they began cracking down on password sharing within households and friends and family. And since they have rolled out their paid sharing, they have seen that in every market that they have done so, revenue has subsequently increased in each one of those markets, which is a good sign for those of you who were worried about them cracking down on password sharing and losing a lot of customers, as they actually saw a 5.9 million user gain. Now that 5.9 million paid net additions this last quarter was triple the expectations of analysts. And they also beat their EPS expectations, but missed on revenues, which may have been the reason there was the initial drop in the stock after hours. Netflix also continued to release strong content this last quarter, as many of it was critically acclaimed when compared to a lot of the other streaming services, which kind of shows and proves that they're still at the top of their game when compared to other streaming services. In my opinion, Netflix has won the streaming wars, and as long as they are able to consistently come out with mediocre content With the occasional hit show, they will dominate this industry as they are showing that they can continually increase profits, as they have proved that their operating leverage really translates into an increased free cash flow over just this past year. Now, Netflix's fundamentals continue to improve, and I think a lot of investors are underestimating the free cash flow that this company will be able to generate over the next 5 to 10 years. Now, the last company we'll be talking about today is ASML. And ASML had upped their full year growth forecast to 30% from 25%, as they continue to see strong demand for their products. And for those of you who don't know what ASML does, they sell the machines that producers like Intel, Taiwan Semiconductor, and others use to make the advanced chips that we have today. They also do not have any other major competition and have a backlog of orders totaling over $42 billion. They also saw maintained demand from their Chinese customers, even though they are not allowed to sell them their latest machines due to export laws that aim to shift the dominance in chip manufacturing to the West and away from territories near China. Now, this earnings season has gone off to a hot start, with Tesla and Netflix and many other companies reporting and huge drops in share price. And I think that this shows that there's a lot of frothiness in the market where expectations are really high, and even if you double beat on earnings and revenue, you really have to have something groundbreaking from your company to push yourself up and not fall back down as this market continues to rally. With that being said, we have a lot more companies to report earnings, with Microsoft, Apple, Meta, Google, Amazon, and many others still coming up in the upcoming weeks. And we will see how this market really shakes out. And until then, I'll see you in the next one.